All right, well, joining me on the line is Puru Saxena. He is a money manager based in Hong Kong, and he is a regular guest on CNBC, BBC, and Bloomberg. He is the founder of Puru Saxena Wealth Management and is the editor and publisher of Money Matters, an economic report read by investors around the world. Puru, thank you so much for joining me on Follow the Money Weekly.
Oh, it's my pleasure.
Peru, this week the Dow Jones Industrial Average dipped below the 10,000 mark a few times as the economic realities continue to weigh heavy on many investors' minds. Looking back over the last 12 to 15 months, the U.S. equity markets are beginning to look like they're moving in a sideways direction. It looks like a sideways market. Based upon your research, where do you see the U.S. equity markets heading in the near term, especially given the fact that we're heading into that tumultuous time of September and October?
Well, we've maintained for about 3 or 4 months now that we were due for a big multi-month consolidation phase, a phase which typically follows any uptrend in the bull market. We view the bear market ended in nominal terms in March 2009. This bear market in the U.S. and most of the Western economies started in March 2000 when the NASDAQ bubble burst. During the first leg down, we went down from 2000 to 2002, 2003. That was the first leg of the bear market. Then we had this huge rally globally from 2003 until 2007, where the Dow Jones doubled, the FTSE, the DAX, most of the markets went up. The emerging markets went up significantly. China was up about 600%, India was up 700%. The developing nations' stock markets went up through the roof during that period. But then we had the resumption of the bear market in 2007 in October, when everything collapsed globally in 2008, and then the bear market ended in October 2008 in the developing countries, and in March 2009 in the US and in most of the developed countries. Our view is that this whole bear market, the nominal low would be seen as the March 2009 low. Due to the money printing by the central banks and the stimulus by the governments, we don't expect those lows to be taken out. Over the short term, we suspect that this consolidation will continue for another few weeks, but then we expect to see a strong year-end rally.
Well, you bring up the money printing at the central banks and the attempts at increasing the aggregate demand at the consumer level by the governments. There seems to be a large and growing debate about whether the United States is heading towards a prolonged period of deflation or whether they're going to experience high amounts of inflation and possibly even hyperinflation. And I would ask you maybe to address the listener and tell us, where do you think things are heading? Do you see deflation? Do you see hyperinflation? Do you see inflation?
We don't think the Western economies are going to slip into deflation, not with Mr. Bernanke running the central bank in America and the inflationist central banks all over the world. Without the intervention of the central banks and without the money printing, we would have had a deflationary recession or a depression, whatever you want to call it. But with the stimulus being applied all over the world and the near zero interest rates and the steep yield curve and the quantitative easing, which has just been unleashed again in the United States, and I suspect that's going to take place in most of Europe as well, we don't believe deflation is going to take place. Over the next couple of years or so, we suspect that we are going to remain in a low growth economic environment in the West. So economic growth will be sluggish. It's going to be a subpar economic recovery. However, we don't expect to see a double-dip recession or indeed deflation. I think people are being hoodwinked into believing that the world faces deflation. If you look at the CPI indices in most of the developed countries, you will note that they are still increasing. And if you look at the money supply growth and total credit growth in the U.S., and in the West, total debt in America is at a record high, and that to us is inflation. It is not deflation. In our view, deflation is a contraction in the supply of money and total credit in the economy. And over the last 18 months or so, what we have seen is that although the private sector in the West, in the U.S. and in most of the Western countries in developed nations in Europe, has engaged in deleveraging, they've been paying off debt. But the reality is that the governments of these countries have taken on huge amounts of debt, and their debt accumulation has overwhelmed the debt contraction in the private sector. So the net result is that debt levels are still at a record high, and that is inflation. At some point within the next 2 or 3 years, the economic environment is going to improve, demand is going to come back again, and the money will start shifting through the economy again, what economists describe as the velocity of money that will pick up. And when that happens, we suspect that we are being set up for very high inflation over the next 5 or 6 years after that. So we are very much in the inflation camp. We don't subscribe to the deflation theory, not with the central banks running this world.
Peru, given that you see inflation in the future, I would suspect that this will drive the price of hard assets like commodities and energy higher. I mean, even when we look at the last just couple of months since June, we've seen wheat up over 50%, sugar's up, cotton's up, many of the soft commodities are up, and of course, the precious metals markets have been doing well still as well. But what about the global demand for energy and commodities going forward? Do you foresee global demand to continue to go higher for energy and commodities in the future?
Well, we have a mixed view on the commodities patch. We have a big investment exposure to energy because we are of the belief that the world's supply of total liquids is going to peak out within the next 3 years or so. At the moment, the world produces about 86.5 million barrels a day of total liquids, which is comprised of conventional crude oil, about 74 million barrels a day, and the rest comes from the unconventional stuff. Our view is that due to the ongoing depletion in some of the largest oil fields in the world, the production of the conventional crude oil is going to stagnate and struggle to grow, and at some point it will start to decline rapidly. And if our work is correct, then we believe that the world will struggle to produce more than 90 to 91 million barrels of total liquids a day. And if demand continues to grow by 1.25% a year over the next 3 years or so, then our world will use 90 to 91 million barrels a day in 3 years. And at that point, we are going to face a massive problem. And we believe that the price of oil is going to rise remorselessly based on supply and demand alone. And when you factor in the money printing, that will just be the cherry on the cake.
Yeah, I've heard you mention upwards of potentially $300 per barrel. Is that a future forecast that you could see rising in the future?
Oh, it could, because if they print enough money in the U.S. and if they print enough money in Europe, the nominal price of oil could go up significantly because when you print money all over the world and if you unleash trillion-dollar stimuluses, then what happens is that the purchasing power of this money goes down. The purchasing power of each unit of money goes down. And in this environment, if the paper money is being destroyed all over the world, then it is quite conceivable that we could see big spikes in the price of energy, in precious metals, and also in some of the agricultural commodities and some of the hard assets. As far as the hard assets are concerned, we don't have any exposure at the moment to the base metals. We sold out of our positions about 4 or 5 months ago because we saw a huge buildup of inventory on the London Metals Exchange. And we are still out of this sector, but in the commodities patch, we continue to like energy very much, the upstream oil companies, the oil services stocks, and we also have an investment exposure to gold and silver miners because we believe that the money printing all over the world is going to create a big inflation problem, and investors are going to go towards gold and silver to hedge their investment portfolios and protect their purchasing power.
Peru, lately, in addition to energy and to precious metals, I've noticed that you've been making some big bets on the continued domestic consumer growth in China. In fact, I heard you recently say that upwards of 40% of some of your clients' asset allocation have been invested in China. I'm a believer in the China story, but share with our audience why you're so excited about the investment opportunities that lie ahead in China.
Well, we see a major transformation taking place in China at the moment because if you see what happened in China over the last 20 years or so, most of this economic miracle was based on exports to the West. So a lot of the companies which made money in the last 20 years was primarily export driven. They used to produce cheap goods and then ship them to America, ship them to Europe. Now, what is going on in China today is quite different in the sense that the domestic demand for goods and services is increasing because if you look at the Chinese GDP on a PPP basis, purchasing power parity basis, has gone above $5,000 per capita. And when that happens, economists have observed that the economy enters into the S-curve, or a sweet spot, where domestic consumption usually takes off. And this is exactly what we are seeing occur in China now. If you look at the Chinese economy today, China consumes roughly a third of all the base metals in the world. They are now the largest energy consuming nation in the world. They've gone past the US. And they are also a big consumers of many of the agricultural products and some of the meat products. I was astonished recently to find out that China consumes roughly 50% of the world's pork. And as the Chinese people move from the rural areas and go into the urban centers, and as their incomes increase on a per capita basis, I have no doubt in my mind that their consumption patterns are also going to change, and they are going to start consuming like the Westerners have done for the last 30 or 40 years. It is worth bearing in mind that the savings rate in China is now very high. The Chinese save about a third of their income. The Chinese government is flush with cash. Their foreign exchange reserves are above $2.5 trillion. And most importantly, if you look at the household debt to GDP in China, it is incredibly low. It's less than 15%, and this includes mortgages. So on one hand, where you have over-leveraged economies in the West, you have this huge pent-up demand in China and also in India and in Vietnam and in some of these fast-growing economies in Asia, which leads us to believe that at some point in the next 5 or 10 years, consumption in this part of the world is going to really explode.